Hello and welcome to the Trend Talk by TheCapitalNet TV. I'm Apurva and today we're going to discuss the long-term capital gain tax and its proposed exemptions. A complex and an unfriendly tax system is one of the major reasons why a lot of founders and startups have shifted their headquarters in countries outside India. We have a tax system that penalizes investing in unlisted companies with a higher long-term capital gains tax. So to put it simply, if an investor has to invest in a company with a greater risk, the higher are the taxes that they have to pay for the same. Individual investors having an income above 5 crores have to pay LTCG tax of 28.5%, including 37% surcharge on LTCG from unlisted securities. Now let's look at a little background of this LTCG tax exemption. Former Finance Minister P. Chidambaram had abolished the LTCG tax for the listed companies in the financial year of 2005. However, he introduced the security transaction tax, that is the STT, instead. Now, the STT tax that was collected for the financial year of 2020 was around 11,000 crores, which was almost equivalent to the LTCG tax that individuals paid. When the Finance Minister Arun Jaitley reintroduced LTCG tax on listed equity shares and equity mutual fund units from the financial year of 2019, the STT continued, resulting in double taxation. This double taxation was one of the major reasons why the entire ecosystem was rallying to get this LTCG taxation exempted. Hearing all these claims, the Standing Committee on Finance, headed by a former BJP MP and Union Minister Jayant Sinha, has recommended to the centre to abolish the long-term capital gain tax. This exemption was extended to all the investments that were going to be made to startups through collective investment vehicles such as angel funds, alternate investment funds, and investment LLPs. In a report titled Financing the Startup Ecosystem presented to the Lok Sabha Speaker last week, the strong recommendation of abolishment of the long-term capital gain tax was made for at least the next 2 years until the startups were able to get back on feet from this pandemic. The steps advocated by the committee include, first, encouraging Pension Fund Regulatory and Development Authority and National Pension Scheme, which is NPS, to invite bids from professional fund managers for running a fund of funds program. Secondly, major banks should also join their hands for funds of funds program. Thirdly, insurance companies, both life and non-life, should be given latitude to invest in these fund of funds. Fourthly, foreign development finance institutions may also be encouraged to participate with local asset management companies to set up fund of funds structure or direct VC or PE funds, particularly in social impact, healthcare, and venture or startup sectors. The report also called for leveling the playing field when it comes to domestic investments vis-a-vis the foreign investments, and also the domestic listings vis-a-vis the unlisted securities. At present, the LTCG earned by foreign investors in private companies attracts taxation at a concessional rate of 10% in comparison to the domestic VC-PE investments being taxed at 20%, that is for LTCG, for an enhanced surcharge of 37%. Naturally, this recommendation was welcomed with open arms across the ecosystem. Anurag Jain, co-founder of a Tiger Global-backed TREDx, shared with Inc42, stating, "The LTCG recommendation will not only make startups as an asset class more lucrative for investors, but also serve as a breather for ailing companies battered by COVID-19. It was also noted that abolishment of LTCG will allow investors and individuals to look at startups as a proper investment opportunity. However, there is also a large group of stakeholders in the ecosystem that don't really feel that there's going to be much of a change when it comes to abolishment of the LTCG tax. They believe that unless the implementation of this particular abolishment is for the life cycle of a VC or a PE fund, which is 5 to 10 years, these short-term 1 or 2 years plan would not make much of a difference. One thing is for sure, the entire ecosystem has been waiting on these exemptions and abolishment for a long time now. However, the nitty-gritties of the implementation of the same is where the impact of these changes will lie. For now, we just wait and see how these recommendations will pan out in the future.